Hi, everybody. Welcome to another episode of Capitalize on Retirement. Today we have what would you call it? Pretty exciting topic, I guess.
We're excited about it.
We're excited about it, yeah. Something we've been doing for a long time. Today we're going to be talking about different type of investment approaches. And specifically on that, we're going to talk about direct indexing versus ETFs or exchange-traded funds versus mutual funds, right? And before we talk about that and before we get into what direct indexing actually is, it's important to understand why it's getting so much attention. So direct indexing was the fastest growing investment approach by a percentage of assets in the wealth management world. So from 2021 through 2024, assets in direct indexing nearly doubled. They're growing at an average rate of 22% per year, which is far faster than traditional mutual funds or ETFs. And we're not saying the investment performance was 22%, although it's been really good. We're saying that the asset class in general is growing. So that growth is because of a multitude of reasons. One is tax efficiency, one is flexibility, and one is cost, which we'll get into. But I think for us, we've been using a direct indexing approach for a number of years. I've been saying we've kind of been at the front end of this, and I think the whole landscape is going to shift.
Yeah, and I think, for us, we've noticed these investment strategies changing over time. And a lot of our clients are, they ask us all the time, what's the difference between a mutual fund and an ETF and direct indexing? And when I look at these strategies, they all serve a purpose.
Yep.
But when you look at direct indexing in general, there's so much tax efficiency with it, and there's so many benefits to it that we feel we have to talk about it. And that's what we want to talk about today is why people are moving from maybe looking at an S&P 500 index fund versus direct indexing.
Yep.
And we'll talk about some of those benefits today.
Yeah, no, I agree. I think this is really exciting for us. It might be a little more technical than we're kind of used to, but we'll have fun with it. We'll keep it high level. So big picture, investing has evolved so much over the past couple of decades. I think about our dad when he started the business, it was all mutual funds. We had Paul in here before. Paul was very familiar with mutual funds, and mutual funds absolutely dominated for decades in the investment universe.
Yeah. And they were great because when you think about it, a mutual fund is a pooling of different stocks and bonds.
Yep.
And so you had these mutual fund managers that were putting together investments for you so that you didn't have to pick those different stocks. They were professionally managing this account for you.
Yep.
And for most people, some of those only have like a $250 minimum investment.
Yep.
So you can get access to all of these investments at such a low cost. Cost of capital, I would say. And it was great. You could be diversified. You could get professional managers managing your money.
And cost of entry is really low.
Exactly. Cost of entry is really low. Well, then fast forward a little bit and index funds became available, right? And so index funds are, people think of the S&P 500 where we're tracking a certain index like the S&P, like the Russell 2000, and we're just tracking that index. And so that's also a pooling of investments, but they're a little bit more tax efficient.
Yep. A little bit more tax efficient than mutual funds because you're not getting that. A mutual fund is a pooled investment where you're with a group of investors. So other investors they sell and trigger gains in the market. You get your capital gain distributions.
Right. So mutual funds, obviously, we see, like you said, a lot of capital gain fund distributions, which are inefficient. Index funds a little bit more efficient, and then we go to direct indexing. So let's just explain what direct indexing is first, and then we'll talk about the benefits. So when you think about direct indexing, it's essentially you're tracking the index, but you're buying those individual stock positions. So instead of buying the whole index and buying that ETF, you're actually going out, and let's say we're tracking the S&P 500. We're buying sometimes all 500 stocks that are in that S&P 500. Sometimes we're buying maybe 50 to 100 stocks that are in that S&P 500. And so the reason we would do that, obviously, is for tax efficiency and then also some cost benefits as well.
Yeah, I think the cost benefits are huge. Like the ETF S&P 500 index, if we think of Vanguard, it's the VOO, right?
Yeah.
And that's a great index, and it's extremely low cost. But if you're doing this where you're actually buying the stock, right? To own a stock now doesn't really cost you anything.
Yeah.
Right? You're obviously going to pay an advisor. You're probably paying an advisor either way. So cost becomes relatively low. Trading costs are essentially free everywhere now. So
Yeah.
the cost to do these direct indexing strategies has evolved so much where they've been around for a number of years. But we talked about cost of entry to mutual funds.
Yeah.
The cost of entry was just so much higher
Yeah.
than it is today, which is very opportunistic for the families that we serve and the people listening here.
Yeah. Yeah. And so, I mean, let's talk about, we'll talk about the tax benefits because we actually own the individual stocks now. And that's where you can really customize this and get the benefit.
Yep.
I think one of the stats that we talked about the other day, the S&P 500 last year was up, I want to say it was like 18% or something like that.
It was like 17, between 16 and 18.
16 and 18%. And I think you said over 40% of the S&P was actually negative for the year.
So if we think about it, the S&P 500 was up, we'll call it 17%. 45% of the stocks in there were negative for the year.
Right. So that really stood out to me because when I look at that, if you're in the S&P 500, you recognize let's just say a 17% rate of return.
Yep.
But 45% of those positions were negative. So if I'm looking at my index fund that I would own, I am up 17%, and if I sell it, I pay tax on that growth.
And you're happy to be up 17%.
And exactly, you're happy to be up 17%. But if you own all 500 stocks directly, well, now you could say every year, I'm going to look at this in December, or just any time throughout the year,
Yep.
and you could say, I'm going to sell some of those stocks that I had a loss, and I'm going to realize those losses, and maybe I offset that with some of my gains in my account. But now you can really customize that.
Yep.
So I think that's one of the huge benefits and why you would want a direct index versus just buying the ETF.
So like you mentioned, you could sell some of those losses. So you're still achieving relatively the same amount of gains.
Yeah.
But your tax alpha, as we call it, is just far better because you said it.
Yeah.
I could sell some of those losses. I could sell some of those gains. I could generate income. If I own it at the fund level, it's a pooled investment.
Yeah.
All of my gains are rolled up in there. Like you said, if I sell it, I'm paying taxes on just the gains. I don't have the losers to offset that.
Right. So if you want to raise cash, you're actually selling those investments at a gain versus if I want to raise cash because I need to take some money out,
Yep.
I could look at which stocks have gone down, which stocks have gone up. Can I offset anything? And then I could get my income and maybe pay no taxes in that example.
And we mentioned it, it's been around for a long time. It just hasn't been accessible because, number one, technology's improved, right? Costs have come way down. And I think investors want more control over that aspect.
Yeah, and they should.
They should. They
Yeah.
absolutely should. And advisors like us, we need that to provide better tax outcomes.
Yep. Yeah, it's, and there's always been that, should I be a passive investor or should I be an active investor? Well, now you can actually be a passive investor, but also get the tax benefits.
Yep.
And so I think that's super powerful, especially in a non-qualified account, a non-retirement account, where you're actually paying these taxes potentially every year.
No, I couldn't agree more. I mean, I think that's the biggest, we've been talking about it for a number of years now.
Yeah. And a lot of people are saving because they want to get to the point where they have financial freedom. A lot of people ask us all the time, well, what are our high net worth clients doing?
Yeah.
They're direct indexing.
Oh,
Right.
without a doubt.
Because if you have NVIDIA stock and you've made $300,000 in NVIDIA stock, well, you can't just sell it. I mean, you can, but you're going to pay a huge tax bill.
Yep.
So if I could look at, well, what stocks have I lost money in? Well, now I can really offset some of that tax bill. So let's just talk about when it actually makes sense to do this, because I want to talk about one of the clients that we both worked with maybe a few years ago. You might not even remember this, but they had an account where they actually owned Home Depot stock.
Yep.
And Home Depot stock lost money in that given year. So Home Depot stock went down in value. He had some other stocks that actually increased in value. And so at the end of the year, we said, hey, let's sell this Home Depot stock and buy Lowe's,
Yep.
which they kind of track very similar. They're in the same industry. And so we did that. We realized the loss. We helped him from a tax standpoint. And now he owns something in the exact same industry.
Yep.
So in the exact same sector. So I just think those are some of the things that you could do, and it's very powerful to look at that while you're growing your assets.
You just, again, the flexibility, the control over the tax situation, and for us, it's one of the biggest things because we focus a lot on taxes. It's a big piece of our planning, and when people have mutual funds, and this is becoming more common. I did a workshop yesterday, and I had a couple people address to me that, well, I'm getting killed in taxes, and it's because if you've been a good saver and you have money in a taxable account, mutual funds are kicking off massive 1099s.
Yep.
Right? And you're paying taxes just to own that account.
Right.
We do not believe in that strategy. I don't believe that you should be paying taxes to have money in an investment.
Right.
You're paying taxes when you didn't receive a penny from it.
Right. Yeah, and it's not what you make, it's what you keep after you pay your taxes.
Yep.
And so some of those mutual fund companies will say, yeah, you've made 12% a year.
Yep.
But when you calculate, you're paying about 3% of that back in taxes, sometimes even more. So you got to really just make sure that when you're investing your money, you're also looking at the tax bill.
And that's where direct indexing really helps. And I think the other thing, too, because there's tremendous tax leverage with direct indexing because the fact that you own the individual shares. But there could also be advantages provided just from the investment side.
Yeah.
Right? Like we mentioned, okay, so the S&P 500 up 17% last year, but 45% of those stocks were down.
Yeah.
Right? So in the S&P 500, we're going to have companies like Google and Microsoft and Apple, and everybody knows the Mag 7. The Mag 7 drove a lot of those returns last year. Well, in a direct indexing approach, we could take overweight positions in those companies, and we could take underweight or eliminate some of those positions that are not performing as well.
Yeah. Yeah, and it makes a lot of sense, too. I mean, if you think about it, during the pandemic, Boeing was one of the top holdings in the S&P 500.
Yep.
When airlines shut down, it was like, hey, should we still own Boeing stock?
Yep.
So when you really think about it, it's more flexible. You could take positions out. If I just buy the index, I own all 500 of those companies.
You own all 500, and the only way they change is if they get eliminated from the S&P 500 or added to it.
Yeah.
That's it. So you were just purely tracking that. Where direct indexing, you're getting an investment advantage approach, but you're getting a major tax approach.
Let's talk about another area because we have some clients who work for larger companies and they get company stock.
Mm-hmm.
So one of the things that you could do with direct indexing is instead of buying the S&P 500, like we have clients who work at AbbVie.
Yep.
We have clients who work at all these different companies, but let's just assume AbbVie.
Yep.
AbbVie stock is maybe a big portion of their overall portfolio. So instead of buying the index where we're also buying AbbVie, maybe we want to buy all the stocks in the S&P except for AbbVie.
Yep.
Because we already have it.
Yep.
So you can get very creative with this, and the tax efficiencies, the investment efficiencies, I just think it's the much more efficient way to invest your money.
And I think in 10 years, this will be much more mainstream than it already is. I mean, we've been using this strategy for the past 4 or 5 years, and we were kind of on the front end of it, like I mentioned before, but I think this is going to become more mainstream because people are more tax aware. Advisors are kind of changing how they structure things and having they want more control over their client's tax outcome. I mean, I think it's just the growth makes total sense to me, and I think that's going to continue on.
No, I think one of the downsides is if you want to invest in a mutual fund, you only need $250 to put money in.
Correct.
If you want to invest into an index fund, you only need a few $100s to invest. To invest in one of these strategies, sometimes you need $25,000, $50,000, $100,000 to actually invest in these direct indexing strategies. So that would be the downside, but it's becoming more and more available for most people, and it's getting cheaper in terms of capital cost.
Correct. And the reason why you have to have the higher minimums is because to go and buy the individual shares at the share
Right.
prices, you have to have more money allocated to it, right? Whether the ETF or the mutual fund, they're pulled, so it doesn't matter. They're pulling those together. So that's a valid point where you do have to have more assets behind it to make it work or to get in it. So
Yeah.
I think
Definitely. And the only other thing I wanted to talk about with the direct indexing strategy, because we see this a lot, is we'll take over mutual funds from other advisors who are managing the money.
mhm.
But then when we buy, let's say, the 500 stocks of the U.S. stock market, well, we have gains in that mutual fund, but we can, if some of those stocks go down in value, we could sell those in that given year, and then we could offset them with some of those mutual fund gains. So then we could just make it more tax efficient, and that's something that you want to constantly be looking at throughout the year. So
That's been a big piece of planning for us where we, people come in and we're evaluating the situation. We're seeing major tax inefficiencies there. And it's not that you can kind of rip the Band-Aid off overnight. It would be nice, but you just can't do that because
Right.
they've rolled up those gains over 30 years sometimes. So you have to rip that Band-Aid off very strategically.
Yeah.
That's where us, the CPAs,
Yeah.
Joel, our CFA on our team, that's where we kind of all get together
Yeah.
and figure out a strategy for that. But that's been a big area of focus for us, especially over the last couple of years.
Definitely, and I think people don't really realize that if I buy the S&P 500 today and I have all these legacy positions, mutual funds that I've made money in, well, I can offset short-term losses with long-term gains.
Yep.
So if I lose some money in the short term in the next 10 days, I could realize those losses and offset positions that I've owned for 30 years.
Without having a tax bill owed.
Right.
But that's why you have to, again, that's why that
Yeah.
direct indexing is so important. You have to be buying it at the stock level for
Definitely.
that control.
No, I think it's very powerful, and I just, is a lot of people ask us, well, you guys talk about direct indexing a lot. Is it better than mutual funds? Is it better than ETFs? And I would say it depends on what you're trying to accomplish.
I mean, each of these tools serve a purpose. None of them are bad,
Yeah.
right? Like ETFs, they're fantastic. Mutual funds still serve a role, right? It gives you control and tax advantages and levers to pull.
Yeah. And it eliminates the argument of, should I be an active investor trying to outperform the market, or should I be a passive investor trying to track the market? Now you kind of get the best, because you can still track the market. You might actually outperform the market depending on what you own. I mean, if you're only owning the top 50 stocks,
Yeah.
and the majority of the stocks are the ones that are performing well, you might perform better.
Yeah.
You might perform worse. But you're tracking the index, but you're also getting the tax efficiency.
I mean, you can, with direct indexing, you can manage some concentrated stock positions, right? So you have like a huge position in Home Depot. Well, we could help manage that. If you have mutual funds, we could help you get out of that. We can adjust risk more precisely.
I don't know if you can call Vanguard and say, hey, I own AbbVie.
Yeah.
Can you take my AbbVie stock out of VOO? I don't think they're going to do that for you, but you could try.
That's the thing. Like, you don't have the flexibility in that.
Yeah.
That's where direct indexing really becomes advantageous, along with all the other aspects of it. And I mean, and it's really inexpensive, which is nice. I mean, it's cheaper. It's cheaper than pretty much, I don't want to say pretty much every mutual fund, but it's a lot cheaper than a mutual fund.
Yeah, I mean, when you buy the individual stocks don't cost anything if
No.
you're on the right platform. So
And trading fees.
Exactly.
Not trading fees. Just so people have kind of an indicator of who it will work for.
Yeah, so number one is investors with taxable brokerage accounts. I think, if you have an IRA or a Roth IRA, you're deferring that tax bill, or your growth is tax-free. And so it doesn't matter as much, if at all. But in a taxable brokerage account, it matters a lot. And so if you have a large brokerage account, or you're saving into that brokerage account, and one day it's going to be large, it's very important.
Oh, it's huge. And it's important for them, especially in a brokerage account, joint account, anything that's taxable. It's important for higher income households.
Yeah.
Right? We've seen this with higher income earners where we could actually control through software
Yeah.
and things like that. We could put capital gains thresholds,
Yeah.
pretty technical stuff there, but those are really important things for higher income earners.
Yeah. I mean, especially if they're retired, I mean, and they're going over certain Medicare tiers
Yep.
and different things. I mean, we could really help control that and manage that and keep that low so that their capital gains aren't throwing their situation out of control.
It's just unpredictable. You don't know what they're going to be.
Right. I would say those focused on tax efficiency. I mean, for me, I want to continue to grow my accounts, but I want to make sure that I'm not paying it all back in taxes.
Yep.
So definitely focusing on tax efficiency first and foremost.
I couldn't agree more, because a lot of people, I think they think if they go to a different strategy or things like that, if they leave their mutual fund, which has performed well, because if I've been in it long enough,
Yeah.
of course it'll perform well. You're not losing any investment strategy, if you will,
Yeah.
or
performance,
return or
potential performance,
Yeah,
right.
that's not, you don't want to let the tax tail wag the investment dog, right? We all know that. And again, it will be more mainstream. It's coming. We're seeing that's why it's the
Yeah.
fastest growing asset class.
Yeah. Yeah, and then just long-term investors who value customization. Like I really value customization because if you're buying the whole S&P 500 or Russell 2000 or Russell 3000, you don't really have customization.
Yep.
But when you direct index it and you own the stocks, you have full customization.
And that's customization over what's inside of it, over the tax layout of it. I
Yeah.
mean, it adds so much leverage. So kind of to close it up, I think mutual funds laid the groundwork for almost every investment program that's out there.
Yeah.
ETFs came in and really helped improve the efficiencies with
Yeah.
mutual funds, right? Help with the tax side. And then direct indexing just adds that personalization and major tax management. So understanding the differences can help every listener out there, and understanding how to use each of these appropriately, especially per account.
Yeah. Yeah, once again, I think that's why it's so important to have a plan and have an investment plan that coordinates with your tax plan, right? Because they all work together and they can make a big impact.
Huge impact. You said it, it's not about what you make, it's about what you keep. And direct indexing is one of those things that can really help us with that.
Yeah, definitely.